Good evening. I am going to talk about Custodian Property Income REIT, and there are sort of three key issues that I'm going to draw out over the next 20 minutes, and they're going to be timing, income, and risk. But actually, I've got quite a few slides to rattle through, but I'll keep coming back to these three items. And I'll go through all the slides because hopefully this set of slides will be distributed. At least if I've spoken about them, they'll make some sense when you review them, as I'm sure you all will. So Custodian, we aim to be the REIT of choice for private and institutional investors seeking high and stable dividends from well-diversified UK real estate. There's a fair bit in that, and I'll unpack that as we go through. But let's start by setting the scene, looking back at 2024. And this is for our portfolio. What have we seen? We've seen rental growth of 5.6% to give us the highest reversionary potential in our portfolio in the last 10 years, so 15% reversionary potential. We've seen occupancy increase from 91 to 92% as at our March year end, and heading towards 94% based on deals we have agreed. We've seen valuations, which had been falling, stabilise since December of last year, suggesting that the market is bottoming out, the investment market. We've managed to conclude nearly £30 million worth of disposals, 24% ahead of valuation. And that has enabled us to both fund our capital expenditure programme and bring down gearing. So all this positivity in the occupational market enabled us to pay a special dividend for the year ended March of 0.3 pence to take the dividend for the year to 5.8 pence per share. And we have been able to increase the dividend for the year in prospect to 6 pence per share. And based on the sort of 12-month average share price, that's giving a dividend yield of 7.5%. So I think, here's a bold statement, that 2024 will be the year of recovery for commercial property. I accept that we are over halfway through the year now, and I've been saying this since the start of the year, but I've still got 5 months to be right. And I strongly suspect I will be right because of the strength in the occupational market, which has rather swum against the tide of investment market sentiment. And the investment market seems to be waiting for someone to ring the bell to say we're at the bottom. And the bell they're all waiting to hear is a cut in interest rates. Will it be August or will it be November? I'm a November man, but maybe there are some optimists in the room and we can debate that later. But in either event, we expect that income is going to dominate total returns. So now feels like a really interesting time. I said we'd talk about timing, to be looking at commercial real estate. And Custodian is very well positioned to perform in these market conditions. Just looking at a couple of the charts on this. Firstly, the map on the right, you can see ours is an extremely broadly diversified portfolio with 150 assets and over 300 tenancies spread across the UK and spread across the principal commercial property sectors. Spread, as you can see, with the majority of the portfolio in industrial and in retail warehousing, the two sectors where we see the most rental growth potential, but also spread through offices, the rather unhelpfully termed other, which is things that aren't any of the other four, and some high street retail, where there is also glimmers of growth. It's been a fast-changing landscape in commercial real estate over the last year. We've seen consolidation in listed property companies, with UK commercial property being merged into Tritax Big Box REIT. So they too have become a diversified fund. Good on them. They've seen the light. We've seen LXI and Secure Income merge and then merge again with London Metric, and Columbia Threadneedle Property Trust also be merged into the London Metric stable. We've seen Eddiston, which is the retail warehouse real estate investment trust, being taken private, having been acquired by Realty Income, and following our aborted attempt to merge with Aberdeen Property Income, their shareholders have voted to wind up that company. So they will be no more in a few months, or so they think. I think it might take them a few years, but nevertheless, that's what their shareholders voted for. And it is also expected that Balanced Commercial Property Trust is also going to be wound up following a continuation vote later this year. So who does that leave in the diversified sector? Well, it leaves Picton, Custodian, Schroders, and AEW. And it's my job over the next few minutes to convince you that Custodian is the one to pick. We've grown over the 10 years since we IPO'd from an initial portfolio of around 100 million to near 600 million of gross assets today. But let's think about the investment strategy. What's our DNA? What makes us different? And I know fund managers love to tell you how they're different to everyone else, and I accept that in many ways we are similar to all the others. We invest in real estate, we collect the rent, and after cost we pay dividends to our shareholders. But we buy slightly different properties. We have a very diverse regional portfolio. We have always paid a fully covered dividend, and we think it's so important that your dividend is paid out of earnings. And we now have, as I said before, a strong reversionary potential in the portfolio. But looking at the real heart of our DNA, this chart explains why it is we buy a large portfolio of typically smaller properties in order to get the diversification we think that's so important. And what the chart is showing is two lines. The dark blue line shows the net initial yield of properties that have traded in the market since 2000 with lot sizes of under 10 million, and the light blue line, lot sizes of over 10 million. So broadly what we're looking at is prime property and secondary property. And there was, until 2010, a 65 basis point margin. Relatively consistent, relatively narrow margin, and we could call that the risk premium. In truth, some of that premium is just a hassle factor. People don't want to manage large portfolios of smaller properties if they could have a simpler portfolio of larger assets. So let's say the risk premium is 50 basis points. What happened in 2010 to see that open up to a 150 basis point margin, which has been maintained since 2010? It wasn't a change in the risk profile of those smaller regional assets and a lowering of the risk of the relatively large prime assets. It was a change in the supply and demand of those investing. So more investors pursuing a relatively large, relatively prime strategy, partly funded by very low costs of debt that enabled them to acquire those lower yielding assets. And at the same time, many of those institutional investors selling their smaller assets and so increasing the supply. So this is not an increase in the risk to 150 basis points from 50 basis points. It's a change in supply and demand. So that suggests to me, with a 150 basis point margin and a 50 basis point risk premium, that we're getting 100 basis points of margin for taking no additional risk by pursuing this strategy. And that enables, of course, for us to pay a higher dividend. But what's the acid test? We've now traded for 10 years. We were able to look back over 10 years and compare our share price total return against the leading UK property index, which is the FTSE EPRA REIT UK index, which is made up of all the largest UK listed property companies, and our close peer group of diversified property investment companies. And what you can see over that period is, and let me preface this by saying, this is with a depressed share price. You know, people have been off property for 2 years now. I think it's going to change. I've already said this will be the year it changes. But even with a depressed share price, And over 10 years, that share price total return from Custodian has been positive 36% against an index that's delivered only positive 20%. Now, if you'd asked me 10 years ago, is this what I would have expected? I would have said, I think, without a hint of arrogance, that yes, this is what I would expect. And I'll tell you why. 10 years ago, we had a portfolio yielding about 7.5% at a time when prime portfolios were yielding 5.5%. So there was that margin. We've seen yields compress. Prime yields came into 3.5%, ours compressed to 5.5%, and we've seen those yields expand again. So there's been very little explicit return delivered just through yield compression, because it came and it went. But each and every year, we've paid a higher dividend. And it's that income return that it is always the case that makes up 70 or 80% of total return from real estate investment that has delivered that outperformance. If we look at the underlying performance of the portfolio over 10 years, it's delivered net asset value total return of 5.5%. And this chart in the top left shows that net asset value total return progression. And you can see the extraordinary aberration that was 2022. I don't know if we were all smoking crack after COVID, but prices went through the roof and valuations got dragged up with them. And then whether you want to blame Kwarteng or Truss, or in fact the just increase in interest rates, we saw that sharp decline in the same year as values came down. But if you were to blank out that 2022 year, it's near straight line performance. And the reason it's near straight line is because the bulk of return has come from income. The bottom chart, we don't need to look at them all, but the bottom chart's interesting because this shows our rental reversion, the potential rental growth from the portfolio. And you can see over the 10 years since we IPO'd how that rental reversion has grown to a record high. So when we're talking about timing, is now an interesting time to invest. Values have fallen from their peak, rents are growing, occupancy levels are high, there's been very little development, so we're not seeing a significant increase in supply. I would contend that yes, now is a very interesting time. If we look back at our dividend performance over the 10 years, the dark blue line is our dividends paid, the light blue line is earnings per share. And you can see that we have stuck to our core ambition to always pay dividends out of earnings, and those dividends have been fully covered for the last 10 years. This is, I think, a really important chart because there's no two ways about it. The basic economics of investing in real estate have changed significantly in the last 2 years. We've gone from virtually zero interest rates to interest rates of 5.25. Where will they get to? I'm sure there will be a broad range of views in the room. I think they won't get below 4%. Well, we might even get stuck somewhere around 4.5% if we're lucky. And maybe we shouldn't be wishing for lower interest rates. Does it suggest that we've got a sick economy if we need interest rates below 4.5%? What the chart is showing is at the bottom in the dark blue, that's our weighted average cost of debt. And you can see the increase in that weighted average cost of debt as our single revolving credit facilities, our only floating rate debt, has increased in cost since 2022. But set against that, we've got the portfolio initial yield in the light blue and then the rather complicated other blue, whatever colour blue that one is, the rental reversion on top. But importantly, you can see there's a very healthy margin of income return over the cost of debt. And even if we were to refinance everything today, and happily we don't need to do that, we'll look at debt in a moment, we could probably refinance the portfolio today at an all-in cost of fixed rate debt of about 5.5%. But that's against a portfolio that's yielding 6.5%. So the custodian model works in a higher interest rate environment. And like it or lump it, I think we're all going to have to expect that we're certainly going to be in a higher interest rate environment than we have experienced up until 2022. Our focus is on income. We make no bones about it. But income security is so important. Firstly, we have a diverse portfolio. This shows you over time how the spread of the income between the different sectors has changed, and what it really shows you is it hasn't changed a lot. All we have done is increase our exposure to retail warehousing at the expense of the high street. And we did that very specifically because we felt that there was better rental growth potential in out-of-town retail warehousing than there was on the high street. And here's a chart. If you were to remember only 2 or 3 charts from this evening, this is one that I think hopefully will be seared into the back of your retina. Because what this shows you is genuine lack of concentration risk in this portfolio. Each of the slices of the pie is the amount of rent paid by any one tenant in the portfolio. And we have no single property let to one tenant that represents more than 1.5% of the rent roll. And that level of diversification you simply can't get elsewhere. And look, I understand being a diversified property investment company hasn't been very fashionable of late. What's been in fashion has been the single sector funds. They've started to call themselves pure play funds. I always get worried when people start using euphemisms to explain what it is they do. Because let's be frank, they're high risk funds. And that's fine, because high risk, they're also high return when the market is going in their favour. And that's certainly been the case for industrial and logistics over the last 3 years, probably even 5 years. Those single sector funds, those high risk funds have delivered high returns. But we are in a more nuanced market now. We've seen a lot of that growth come through, and we believe that the risk mitigation of diversification is really important. By having a broadly diversified portfolio, it doesn't mean we have to sacrifice the quality of income, the quality of our tenants. And this chart looks at Experian credit ratings of our tenants. And what it shows is that over 80% of our tenants are considered lower than average risk. So very diverse, good quality income, spread across the UK, with reversionary potential, and I'm going to flick over that in the interests of time, and with a strong balance sheet. So we have 4 tranches of debt, which you can see in the chart on the left. The second tranche is our revolving credit facility. That's where we've seen the slight increase in cost over the last 2 years. But when you look at refinance risk, our first refinance date is this time next year, a £20 million facility with Scottish Widows, currently paying 3.94%. If we had to refinance that today, that would cost us an additional $400,000 a year. But that's less than 1% of the rent roll. So it's not a significant refinance risk. And if you look at the forward curve for Sonia, there's a very good chance that by this time next year, the cost of refinance might be somewhat lower. So to summarize, and back to those points I made at the start, diversify to reduce risk. Focus on income, because it's income that drives total return. You need a robust balance sheet to mitigate risk and to enhance earnings. And investing now with a dividend yield of 7.5% and with the potential for some share price recovery, you could easily be looking at double-digit returns from Custodian. Thank you.
Thank you, Steve.
Yes, thanks for that impressive presentation. I certainly will consider seriously what you've said. Our new government reiterated today in the debate on the King's Speech that they're absolutely committed to expanding the economy. Not sure how, but they're certainly very confident they can do that. I wonder if your own research suggests that's achievable, and what impact that might have going forward on Custodian's hopefully profitable future.
Well, economic growth is good for real estate. People need more space, they need to employ more people, those people need somewhere to go to work. So growth is good for real estate. in most cases. I thought it was interesting in the King's speech that they were talking about the great things they're going to do to the planning system, and by God, they need to do some things. But I haven't heard it yet said that in order to bring forward new development, developers need to make a profit. You can employ as many planning officers as you like, but if it's not profitable, we're not going to see more development. So they've got their work cut out. You know, none of the problems that the last government left behind have gone away. But I hope that there is a renewed sense of optimism and we see that growth, and it should be good for real estate.
Thank you, Richard. Any other questions? Got a question here, Martin, Steve. And then that gentleman over there.
Could you give an indication of your fees?
Yes, our OCR is 1.3%, so ongoing charges ratio.
Yeah, this gentleman here.
Straight question again. Net asset value per share. Can you give us that?
93.4 pence per share. So we're trading today at about 77 pence. So we're about a 16% discount to net asset value.
Thank you.
Can I just ask on that, just following from that, Richard, do you think earnings per share is a better measure of a company's progress than discount to NAV?
You ask all the best questions. You're absolutely right. Of course it is. We just heard a really interesting presentation from Cohort, and the value of that company has absolutely nothing to do with its net asset value, it's all to do with its earnings. And the same is true for real estate. You know, we talked briefly about Aberdeen Property Investment Trust being wound up. The best guess from those in the know in the market is that that portfolio will sell for something like a 15 to 20% discount to its net asset value. So for those shareholders who were holding out as net asset value as the key measure of worth, they're going to be disappointed. If, however, they had focused on earnings and earnings yield. So for us, you know, earnings last year of 5.8 pence, share price of 77p, that's an earnings yield of, you do the math, 7.5%, 8%. 7.5%, 8%. A much better measure. And if you look at the birthplace of real estate investment trusts, which is the US, if you look at a US REIT and their quarterly trading updates, you will find no mention of net asset value. They hold properties on a depreciated book value. It's all about earnings. It's a much better measure, but we're stuck with both a regulatory system that requires us to constantly refer to net asset value, and shareholders that think that net asset value is more important than earnings.
Thank you. And that gentleman there, please.
Hello. Thank you again. I'm wondering, you are letting your properties. Do you let properties to governments? They are short of prison space. Or do you let or universities for their student accommodation? We do have some
migrant
people.
We do have some government tenants, but no prisons. Our properties are far too pretty to be used as prisons, and no student accommodation either. But we do have some government tenants. We've got an office building in Sheffield with one of the Home Office departments in it, and other various sort of government-related tenants.
University students or migrant hotels, etc.?
No, none of the above. All typically commercial property.
Questions for Richard? I've got another one here. Could you just explain about reversionary potential, how that's you come to that figure?
Yes.
This contract's already agreed, I take it.
The reversionary potential is our independent valuer's estimate of the rental value of the property today versus the rent we're collecting today. So the rental value is estimated to be 15% higher than the passing rent today. So it's an independent evaluation of rental value.
Right, okay.
It's been our experience, particularly when you're in a growing market, when valuers estimate rental value, they base it on deals that have been agreed in the market. So it tends to be backwards looking. but we're agreeing rents in a forward-looking way. So we've tended to re-let property at ahead of the estimated rental value. So I think that 15% reversion is a pretty comfortable figure.
Okay. And did you have an acquisition recently of Drum Income Plus?
We bought Drum Income Plus REIT probably 2 years ago now,
Right.
a little bit more than.
Oh, was it that far back?
And it's,
Okay.
yeah, that is, it's sort of fully embedded in the portfolio.
Yeah, all covered across. Okay. Any other questions for Richard, please? Oh, this gentleman here, please, Steve. Thank you.
Couple of questions on diversification. Are you looking at all about investing abroad at all and spreading your portfolio overseas? And secondly, you mentioned about the US starting this this sort of trend there. I believe a big trend now is buying up housing estates and renting to private tenants. Is that something you might look at in the future?
The short answer is no and no. We are a UK diversified real estate investment trust. I think as soon as you start investing overseas, you bring in all sorts of other risks. And, you know, you can be a jack of all trades or in my case, perhaps a master of none. But, you know, you can try and spread yourself too thin. So no, we're very much a UK focused. Have we got any residential in the portfolio? Little bits and pieces, and we've just developed 4 flats above some shops in the centre of Shrewsbury. They let before we'd even created the marketing materials. And that's quite an interesting use of vacant space in buildings that we already own, where we can drive additional income streams. You know, similarly, we're doing the same thing with photovoltaic cells, putting solar PV panels on the roofs, particularly of our industrial buildings, and then selling that solar electricity to our tenants through a power purchase agreement. They get a reduced rate of electricity. They also are using green electricity, which is good for their ESG credentials. And we have generated additional cash flow from buildings that we already owned. So we might see a bit more residential creeping in, but it's absolutely on the fringes.
Thank you. This gentleman here, please, Steve. Thank you.
You mentioned enhancing some of the properties you already own. Do you actually develop any property? Do you have a partnership with construction companies and actually develop from site to completion?
We have developed one property in the last 24 months, and that was a redevelopment of a property we already owned, which had just reached the end of its economic life. And while we could have relet it at a low rent, we felt the best thing to do was to level it and build again. In all of those cases, we don't have that in-house development expertise, so we partner with people that know what they're doing. And again, it's about spreading yourself too thinly. We know what we can do. But we do a lot of refurbishment. That's part and parcel of managing a commercial property portfolio.
And who are the major shareholders, Custodian?
A typical shareholder, we've got a few of the sort of institutional indices make up, you know, the big individual shareholders. But beyond that, it's a very broad base of private client, wealth managers and private clients. Indeed, since I first started coming to these events, the shareholder base from AJ Bell clients has increased from 1.8 million to 6.3 million. And we've seen similar increases from, sorry to swear in your presence, Hargreaves and Interactive Investor as well. So we're seeing, you know, platform retail investors making up a big chunk, but it's principally categorized by private client wealth managers.
Okay. Any other questions, please? This one gentleman here, Steve. Thank you.
You talked earlier about your discount of 16% to net asset value. Yep. How does that compare to the sector, and do you do anything to manage the discount, such as share buybacks? We have regularly considered share buybacks. We haven't done any yet.
Our experience looking at others that have tried it in listed real estate is that it doesn't really work. It's very short-term medicine and it doesn't really deliver what shareholders are looking for. Plus, we have to answer the question, is that the best use of shareholders' funds? If we buy back shares and we're cancelling a dividend of 7.5% when we could be investing in solar PV where we get a 12 to 15% return, that's perhaps a better use of funds. In terms of our discount compared to the peer group average is probably 20-25% discount, and we're at 16. So we've always had a slightly higher rating than our peer group, but you know, I think all these shares are looking good value at the moment.
Okay, thanks, Richard. Any other questions from the audience? I think that's it for the moment, Richard.
Thank you very much.
You stay for a drink?